Good Greetings to everyone. I hope you are all good. All right, so let's quickly brush through tutorial set 6 and then see the way forward. You can maybe forward this video fast out to like 2x. Yeah, I think that one will be okay because this tutorial set is 4 key, 10 questions, 10 mafia strong questions. So I'll be skipping some though, but I'll be showing the answers here. Right. So those that are readings and they are tax, like they are law based, I will just make sure I leave the screen for a while so that you take a screenshot and then you read it. But the ones that are involving calculations, yes, that's when I'll be tackling because that's where our problem mostly lies. So I'm going to do that. So kindly like this video and also subscribe to my channel if this is your first time coming across the video. All right, so let's move to question 1. Question 1 is saying that although the scope of withholding tax covers employment, business, and investment income, not every income is subjected to withholding tax in accordance with the Income Tax Act 2015. Act amended, Act 896 as amended. So they say explain 4 of these withholding tax exemptions. And these are they are premium paid to a resident insurance company. These are all in the Act. Payments for sale of goods which constitute trading stock of both the vendor and the purchaser. Mind you, I took all these answers from the ICAG website and I did some adjustments. So basically, this is how we are supposed to be answering our questions, right? So not actually all, but most of them, like the act questions. Yeah. So you have to look at how it is being solved there. So this is basically the projection, how it is being solved. So I'm just showing it here. I don't have to read all so that we save time. And B, a gain made by a person from the realization of an asset is the total amount of consideration received for the asset, for the sale of the asset, less the cost of the asset at the time of realization. So it is asking us when is an asset realized, and this is also in my video, right? I've explained this in my video. When an asset is realized, when the person dies, and when there's a transfer of ownership and those kind of stuff. So when a person owns an asset, so if the person parts with the ownership of the asset, including when the asset is sold, exchanged, transferred, distributed, redeemed, destroyed, lost, and etc., and where the person who owns the asset also dies, if in the case of an asset that is debt claim, right, where maybe someone is owing you and you try the possible best to get the money and you are not getting it, and like they are all, it means it has been realized, right? And then if the asset is a trading stock, a depreciable asset, and capital asset of the business, or the asset is an investment asset, and that asset changes its value, its original characteristics. So we can go through this. This is straight from the art. So that's it for the, I can't read all so that I don't have to read all so that you will save time on this video because I recorded one just a few minutes ago. And I also have to go for class, so I have to do this fast. C, gift means a receipt without consideration or for inadequate consideration. Explain how an individual who receives a gift in relation to employment, business, or otherwise will be taxed. So this, remember that I said this, that whenever you receive in my videos, whenever you receive a gift, it's either you can tax it separately at 15%, or you can include it in your employment income, business income, or investment, and then use the graduated tax schedule. So when an individual receives a gift in relation to employment, business, investments, or otherwise, the gift is added to income and tax. However, an individual who elects for gift to be taxable separately should be taxed at the rate of 15% on the total value of the taxable gift received by a person within a year of assessment. So let's look at question 2. Fortune acquires shares in Obolo Company Limited, a manufacturing company situated in Nsawam. And the following are the shares. These are some of the technical questions, right? So he acquired 100,000 ordinary shares at 115,600 on March 14, 2020. He also acquired another 220,000 shares on 26 November 2020 at a price of 1.2 per share. On 24th December 2020, he sold, and I'm sure that if any question will come under tax, under shares, right? Capital gains around shares. This is how it is going to look like for the building type. There are some complex questions down there, and I doubt they are going to give us that question at our level, but we'll tackle it. All right. So, but yeah, let's go through because anything can happen. We know Eugene. Um, so rate attracted a sale commission of 1.5% of the sales value to the brokerage firm. So compute the capital tax gain. And they say we should compute the capital tax gain. First, if you want to compute the capital tax gain, you have to open a schedule where you have to keep all the records of your shares. So that's it here. You have details of the share, you have the price of the share, and then we have the amount here. So first of all, we purchase 100,000 at one, all in total for this one, 115. So when we divide, the price per share will be at this, right? And then we purchase again 220,000, and then 1.2 was the per share price, right? When we multiply this, what we get. So in total, we have 320,000 shares for 379,000 as the total cost or the total amount we have here. Now, we sold 235 for 305, right? Now, we want to calculate, if we want to get our realization, what we have to do, or if we want to get our capital gain, what we have to do is we have to know the consideration we receive and also the cost, right? The way things are mixed up here, we can't actually get the cost straight away. We can't really do it well. So there is a formula for that. So it is going to be A times C over A plus B, where A is the sum realized, the amount you received, the amount you sold the share for. And then B is the value of the remaining shares, the value of the remaining shares. And then C is the cost of shares on disposal. So cost before disposal of shares. So the cost you computed before disposal, right? So now what maybe some of us will be asking ourselves is, how did we get the value of the shares remaining, right? So the number of shares remaining after selling 235 was 85,000. Now we want to know this 1.3, where we had this 1.3. If you want to know this, it is going to be the 305,500 divided by 235. So, right. In some questions, they will give you the value as at that date. So the price per share as at that date. If they give you that, then you don't need to do this and then get, you don't need to do this and get 1.3. Right. But if they don't give you, then this is what you have to do. You have to just divide the value by the number of shares sold, and then you get the price of the share as at that time. Right? Do you get it? Yeah, I'm sure you get it. So sometimes they might give you the value as at that time, then you are going to use that. If they give you, use that. If they don't, this is what you are going to do. All right. So now, after doing that, A times C, right? We've defined C already to be the cost before selling, which is here. So A times C over A plus B. A, which is the same thing, plus B. It's 5,000 times 1.3 has it here. So in total, we had a total cost of 278,768.5. Now we now come and then compute our capital gain tax payable. So the sum realized, the amount we receive for selling the shares will come here. Our costs, which we calculated up there, will come here. Then commission that we paid 1% commission, right? So 1% commission of we paid 1.5% commission. So 1.5% commission on the amount we received, right? And we had this. So our total cost is going to be this. And when we take it out, this will be our capital gain, right? Now, when we find our 15% of it, we are going to get our what? Our capital tax gain payable. There is it here. All right. So let's move to B. An individual who is required to furnish the Commissioner General with a return in relation to a gift has to do so to enable the Commissioner General to subject it to appropriate tax. So explain the treatment of a gift not received under employment business. So this is it here. So an individual, that's what we spoke about. So an individual can elect for the market value of such a gift received to be taxed separately at a flat rate of 15%, right? And the individual shall within 30 days of receipt furnish the Commissioner General rates a return in writing. Person who is ascertaining the profits and gains of that person or of another person from an investment for a year of assessment or part of that year shall include in the calculation an amount specified in respect of a gift received by a person other than a gift received in respect of a business or employment as substituted by the Income Tax Act. Income Tax Amended number 2. And this is basically a law that is there. So you have nothing to like, you don't have to run away from it. Chew it. All right, let's move to question 3. All right, so question 3 is saying that the provisions of the Income Tax Act 2015 requires a resident person who pays an amount for works or the supply of goods and services to another resident or non-resident person create a source in Ghana to withhold tax from the payment at the rate specified under the paragraph 8 of the first schedule of the Act and pay same to the Commissioner General. So under this, the attendant to explain what final withholding tax and withholding tax. So final withholding tax are final in the sense that once you are taxed at a final, like they apply a final withholding tax on you, you are not going to include that particular transaction in your chargeable income. But withholding tax on account is not final. Once you are taxed on it, you are still going to include the amount in, not the tax amount, but the transaction amount in your chargeable income. And then later when they calculate the tax, then they will take that the tax on account from it. So this is explained further here, which you can pause the video, you can pause and then read through, right? I've briefly explained it here. You can pause and then read through. All right, so B, explain the tax credit certificate and its importance. So the tax credit or clearance certificate is a document evidence is a documentary evidence issued by the Ghana Revenue Authority to confirm that the taxpayer is up to date with any tax payment and has met all applicable tax obligations at the date of issue. So with this, The Commissioner General is required upon receipt of an amount of retail tax paid issued to the withholding agent in favor of the payee of the payee a tax credit certificate, right? So this is basically it. You can read for the reading in there. I told you I'll be skipping it. Let's do the calculations and then these are laws that you can just recite it over and over again. Becca one. So see, yeah, baby acquired shares in Adom Limited as follows. So first February 2019, bought 1,000 at 2, March 1,500 at for this. Then in June, bought 2,000 at this. And then in April 2021, bought this at this. And then 2021 again, bought, okay, had a right issued where 1 for every 10 shares. That's 1.5. And then sold 3,800 shares at 6. So, yeah, baby, it's computation, like what we did for the first one up here, right? What we did for the first one up here, we are doing similar one again, right? So purchase first, this was the amount she purchased, and this was the rate, this will be the total amount. And again, we did the same thing too for this. It was here that's 4, so you have to divide. That's why we had this. And then we have to divide and then get the share price. Then purchase for this 1st June to the purchase 2,000 is here at 3, that's here. And then February, April 21, the purchase this. And then they issue the rights share. So right was out of any 10, out of the shares that you're having, every time we are going to give you 1. That's why it is 1/10 times the shares that was available here. So when they say 1 share for every 10, it will be 1/10. But that's what we are having here. And then we are having now a right share of this, and it was actually 1.5. And there is it here. We'll get a total of this now. That's one, right? Now they sold now this will be our total share, total value or total cost or whatever. And then now they sold 3,800 shares here. Right. So they sold at 6. Now they've even given you the price. Here they've given you the price. You don't have to divide anything again. They've given you the price here already. So since they've given you the price, that's what you are going to use. So now the sum realized or the amount you sold the assets for is going to be this 3,800 times this, right? And then the cost is going to be, as we know, A times C over A plus B, where A is the sum realized and B is the value remaining, and then C is what the cost as at that time. So after selling the shares, this was the one that was left. We multiply it by the value 6, we get this. Now our cost of share before disposal was this. So that's what we are doing here. So A times the cost over A plus B. So after doing everything, this is what we will get. Yeah, so this is what we get. Right. Now our capital gain on that particular distance is going to be this minus this, and we get this as a capital gain. Now we are going to find our 15% on it to get our capital gain tax. And then we get the capital gain tax here. Simple and straightforward, right? Okay. So D, explain the realization of asset by way of measure, amalgamation, reorganization under section 47. So this is it here. Realization of assets as a result of merger, amalgamation, or reorganization. The gain on realization of an asset accruing to or derived by the company arising out of merger, amalgamation, or reorganization of a company is exempt from tax where there is what continuity. Where there is continuity of at least 50% of the underlying ownership. So if the reorganization came, then there is at least 50% ownership still in the assets, then there is no realization of the assets, right? So this was treated in realization of assets. Yeah. So this was the exempt part where they will be exempt. All right, so let's move to question 4. Question 4 is saying that the following information is available to you as a tax consultant. Meanwhile, we'll do that statement. Compute taxes from the above information and indicate whether the tax is final or not final. What I will let you know is that with this question, once you see non-residents, if in case you remember the tax rate per know that is final. All the non-residents are final. Because Obi only has no on account, the account. So the rest are final. So now here is the answer. Dividend paid to resident person. This is the amount here, 100,000. The rate is 8%. Dividend is 8% on both, right? And it is final. That's why we are having it here. Dividend paid to non-resident too is the amount that was in the question, 8%. This will be the tax when I calculate 8% on it. Then it's also final, right? Payment of goods to residents. As far as it is more than 2,000, it is 3%, and it is not final. Yes, it's right. Resident. As far as it is more than 2,000, it is 3%, and it is not final. Payment of goods to non-residents. Um, um, Supply of goods to non-residents, 20%, and it is what? Final. See, non-residents in Quadre final. Rent, residential is 8% final. Non-residential or commercial is 15% final. Right, this is it. 8% residential. Uh, Rent, non-residential is 15% final, right? Natural resource payments is also 15%, and it is not final. Let me see. Natural resource payments, 15%, and it is what? Final. Okay, I've made a mistake here. The final tax. Natural resource payment is 15%, and then it's final. And then management and technical service is 20%, and it's final. And then interest paid to financial institutions, yes, it's also exempt. It's an exempt. So they'll bring this one here to confuse it. The royalty paid to non-residents, right? Royalty paid, the same thing. Also final 15%. So it's here. And royalty is 15% final. So that's it for that question. So simple and straightforward. It's in the slides. Now B, we unsold the warehouse on 13 June 2022 for 640,000. The warehouse was purchased on 14 December 2020 for 328,000 for investment purposes and unincurred the following, right? Now they say we should compute the tax payable. Remember realization, we first bring in the consideration received, then we less for any incidental cost, which includes the purchase and then any other cost. So that's what you are seeing here. When we less everything from it, you are going to get 286. 286,000. So now this will be our gain, and then when we apply our tax theorem of 15% capital gain tax, we get this, right? Okay, so see, when a gift is received by an individual, and that gift is not in respect of business, employment, the taxpayer shall within 21 days of receiving the gift submit to the GRA in writing a return containing certain information. Right. Now, in reference to the above statement, state four details the taxpayer must provide. So first, the description and location of the taxable gift, the total value of the gift, how it is calculated, and the tax payable with respect to the gift, the full name and address of the donor, and then any other information they will ask you. Remember, if you not remember anything from any information required by the Commissioner General, you should remember, and also the description and location, the value is very important. In the full name, you can remember everything. D, what constitutes realization of capital assets? So if the person parts with it, if you include whether the person sold it, exchange, transferred, distributed, redeemed, and whatsoever. And then also in the case the person ceases to exist, and in the case where the assets other than trade, so we've treated this up there, right? So you can, let me just be waiting for like 15 seconds, and you can be taking screenshots. So E, explain the transfer of assets for no consideration under Section 45. So transfer of asset for no consideration is more or less like selling an asset without taking money, right? So under this, still the Commissioner General will what tax you because on some huh. So these are what it entails, subject to section 43 and 44, where a person realizes an asset by way of transfer of ownership of the asset to a person who is in control relationship with that person by way of transfer to any other person by way of gift other than under a will or upon whatsoever. So these are all the distance. Just read it. I don't have to read all and then take all the time. So you can read this, right? So basically that's what I'm trying to say, that um it is more or less like you giving out an asset without taking money, right? You selling it without taking money. And the Commissioner General will not understand. This is the last thing. Let's move to question 5. Persons making payments for the supply of goods and works. Goods, works, and services are required by the provision of have to finish within the next 20 minutes. To withhold tax on the gross amount and rates, gross amount at various rates and pay the same to the Commissioner General. In reference to the above statement, explain what goods, works, and services mean, right? So this goods means every object, every kind and description, including raw material, products, and equipment and objects in solid, liquid form or whatsoever, as well as services incidental to the supply of goods if the value of those incidental services do not exceed the value of goods themselves, right? So goods include movable, tangible property, thermal, electrical energy, heating, gas, refrigeration, air conditioning, and the likes. And then works, one point I'm reading because where deep will Miami Japan is defined to include work associated with the construction, reconstruction, demolition, demolition, repairs or renovation of a building, structure or surface, and includes site preparation, excavation, erection, erection including erection of mast for telecommunication, business. Oh, Jesus, save me, why? Panidi, what help? Uncle. So, assembly, installation of plants, fixing of equipment, and laying out materials, decoration and finishing, and any other. So these are all some reading. So services also means furnishing of labor, time or effort not involving the delivery of specific end products other than reports which are merely incidental to required performance and includes consulting, professional and technical service, but does not include employment agreement or collective bargaining agreement. All right. So B, the following information relates to attacking bought shares, bought shares, and sold shares. Share, they've given you the price per share, right? And the commission is 1%. You apply the same thing that you've been doing, same thing. You use the formula to get the cost. Then the same thing that you've been doing, right? And then we arrive. This is the cost. Now, All right, so everything will shift here. You subtract. This will be our capital gain. Apply 15%. This is it. Yeah. Right. Now they're asking us for what is the tax treatment for gift received. We've explained this over and over and over again. This is the same thing again. So you can go through. Now question 6. Papa Dike purchased a house in Medina area, Greater Accra region in the year 2010 for 400,000. The acquisition expenses incurred by the company amounted to 50,000. In June 2019, Papa Dike sold the house for 700, while the technical expenses incurred were the following: this agent, solicitors fee, advertising, accountancy, income tax, valuation fees, right? So, yeah, as we know, consideration, if you want to get the capital gain, consideration received minus any other cost incidental to it. So, we've treated all of them. Treated all of them. This is what we get as a total distance. Then, gain from realization will be this when we subtract from it. Then, tax payable is the 15% times this, then we get. And here they are saying that Papa Dike also sold for 1 million uh, in September 2019, Ghana government security. As far as it's a government related this thing, it is tax exempt, so we don't treat it and fine. So we leave it. That's why we treated only the first one. So they brought that one to confuse us. Then B, Mr. Nyamiche John is a member of Community Christ Church. Nyamiche does not run a business, neither is he into employment. In 2018 of assessment, he received the following from his pastor who just returned from UK. So he received a wristwatch worth 100 euros, shoes 120, mobile phone 150 euros. Right. Now, the exchange rate for that particular year was 1 euro is 6 cities. And the 1 euro in numbers, they all 18 or the 17 cities. So compute any tax payable. Right. So now what we have to do is we just have to sum everything up. We get 370 euros, right? And multiply by the available rates, we get the market value at Ghana City. We find our 15% on that amount. This is the amount of tax that we're supposed to pay. So we tell what the GRA is register. And then GRA. Ah, it's a nipa ni niska. It's all ton at the end about no look here. How? Oh, see, the following unstructured invoice has been forwarded to Adamu, and this is it, a standard rate of supply. This is it, goods invoice, VAT inclusive, right? So now we are required to compute the withholding tax payable. Remember, when we were doing withholding tax, before you calculate withholding tax, you have to take VAT, you have to take VAT and anything containing VAT in it, and then now do what? Find your withholding tax. So that's the same thing we are going to do. This is the invoice value. And then now the VAT is 25%. So we take the VAT. When we are done, we take NHIL and then get fund. And then now we come and then apply the withholding tax on it. That's the same thing we'll do here. So we take the VAT. The VAT is 12.5%. So you can just find 12.5% of the 3 million. So something like this. 12.5% times 3 million, right? So when you do that, after doing that, you are going to get Hey, it's inclusive. That amount is inclusive in there. So if we want to get, so if it is not this, I'm coming. It's not this. So if we want to get uh the VAT inclusive, it's already inclusive. So if we want to take it out, then it is going to be um 112.5 over 112.5 112.5 times 3. It is going to be something like this because it has been included already. Times 3 million. Then we are going to get our VAT amount, right? We'll get our VAT amount to be this. We'll get, when we do this, we are going to get, we are going to get this. So after getting this, then we take it out and then get our goods less VAT. We've taken VAT out of it. Now, when we take VAT out of it here, it will be left with less VAT. Like we don't have VAT in it, but we have NHIL and then get fund in it, right? So you have to take the NHIL and the VAT also out. Where the NHIL and then get fund. Now the NHIL and the get fund, when we add them together, it's going to be 5%, right? So we also do 5 over 105 times 300, hey, 3 million, sorry. Hey, how many border man times this 2.667, this one. So 2.66666. You actually have a 38.67, right? So 5 over 1 over 5 times 2.66666. Then we get this. Right now, we take that one two out. Now we take that one two out of the 266, and then we get this. Now this is the raw amount that we can apply the withholding tax of 3% on it. When we apply the 3% on it, now this is what we get: 76190.48. Or if you want to get here, for example, if you want to get this amount straight without going through these steps, you can also do it this way, where it is going to be 100 over 112.5 times 3 million, and you are going to get this straight, right? You are going to get 266 straight from that side. So I'm going to get it straight from that side. Then, if you also want to get this one straight, if you also want to get this one straight, without going through this one by one process, it is also going to be 100 over 105, which is the get fund, which is 2.5% plus the NHI, which is 2.5% times the same amount, which is 2666666.67, right? So when you do the same thing, you are going to get this straight away, right? So it depends on you. Maybe you are in a hurry and then the time is about to share you in exam, so and try this and do it fast. But on a normal note, you can do it step by step and then get all the marks. All right. So now they are asking for compute the penalty payable. Assume that, so the penalty payable is in the law that you are going to be charged 500 cedis per month plus, and then this one is the incidental one, that will be multiplying by 8 days by day. So here they said 12 days. So 500 plus into bracket 10 times 12 days. And this is in total what you are going to pay. Now the D is asking what are the features of the tier 3 pension scheme? And this is the suggested answer. Can screenshots and then go through. Now let's go to question 7 fast. A resident person who makes a payment to another resident person in respect of and rental of residential and non-residential premises is required to withhold tax in accordance with the Income Tax Act 2015 as amended. States the taxation principle applicable to rental distinct. So this is it here, where it is the 8% and then the 15% in case 8% is for residential, 15% for non-residential. Right. And I giving I about how will you treat this transaction where a person makes a payment to another resident person conducting a business of sale or renting of residential or non-residential premise. So where a resident person makes payment to another person conducting a business of the sale or letting residential or non-residential premises, the payment shall be treated as payment for the supply of service and not as a payment on investment in return. The tax shall be withheld at 7.5% and shall be treated non-final withholding tax. The amount withheld should be treated as tax withheld on the account and not as final because it was another resident person. All right, so B, on the death or part as divorce settlement or bona fide separation agreement, an individual may transfer an asset to a spouse or former spouse. What are the taxation rules on this arrangement? So these are the taxation rules on the arrangement and read through. See, Madam Gifty Coombs was appointed as a minister for state in 2018. On the occasion of her birthday, she received a gift of 8,000 Toyota Land Cruiser worth 1 million, and a cash of 20,000 from the mother-in-law in Afghanistan for at that time dollar was around 5 cedi, right? So we convert everything to cedis, we add all of them, then we tax it our normal 15%. That's what you're seeing here. Question 8. Abnormal organ. This is somehow technical. This is what I'm saying. Say it's unlikely that they will give us a question like this, but if in case to the answer is here, you can go through. Abnormal acquired 2 mansions, one at East Legon, Accra, and other at Kwadaso, Kumasi, on 1st January 2010 at the cost of 2 million and 11.5 million respectively. Abnormal lives on the property at East Legon on 10th March 2019, she used 2.5 million to convert part of this dwelling house into a self-contained flat and sold it to her younger brother for 3.3 million. The property at Kwadaso in Kumasi consists of 2 detached bungalows, and she sold one of the bungalows to her elder sister for 6.3 million. Also on 10th March 2019, the market value of the apartments she sold to her younger brother at the time of sale was 4 million, whilst the market price of the bungalow sold to her elder sister at the time of sale was 8.75 million. She had used 1.95 million to refurnish the bungalow that was sold to her sister. The market price of the unsold bungalow on 10th March 2019 was 11 million. Sorry. So there's a complete capital tax gain. So looking at here, you see, he sold this thing to her sister at 6.3 million. But they are saying that the value of the assets was 8.75. So the taxman will not use this one. The taxman will use this one to compute. And then he sold this one to her younger brother for 3.3 million, right? And then the actual value is 4 million. The taxman is going to use this formula. So let's look at it. So to the younger brother, we use the market value here. We less the cost of construction, which was 2.5. This is our capital gain for that side. Now, on the sister side, looks more complicated. Right? We take the consideration as at market value, right? Then we less the cost of parts sold. So they sold parts and then they left some. So we have to use the A times C over A plus B formula, right? Where A is the sum realized, which is the market value they are using here, right? And then C will be the cost as at that time. And then A again, the sum realized, and then the 11,000 here is the market value as at that point, the unsold one, which is the normal formula we've been using. So in all, this is the cost we realized we got, the cost we got, right? Now, all right, so in all, this is what we got. Um, in all, this is the cost we got, all right? Then we added the cost of refurbishing the bungalow to it here. To use this one to furbish it. So we add it to it. And then we add this. So I've run the figures. That's why you're seeing that way. So I've run it to the nearest whole number. So now this is it. Now we take it out of the consideration we received here. Then this will be our total capital gain. Now, if we want to compute the capital gain, we have to add the two of them, right? The first one received from the brother and then from the sister. So we compute the two will be this, 15% of it will be this, and then this is what you are going to pay to the taxman as your capital tax gain. So now let's look at B. B said the following are the distance that they've computed. The following relates to payments by Manita Limited, a company resident in Ghana by another company at the time as well for class. Both companies are not exempt from withholding tax, right? So we have to calculate the withholding tax. Goods are saying 3 million, services are saying 1.2 million, works are saying 2,000, 2 million, sorry. On scrutiny, the company records the following additional information. So it came to light that the goods above include dividend of 10%. So we have to try our possible and take it out and then tax it differently. Then the service above relates 50% management and 50% technical consultant. So this one we divided into two, different from management and then different for consultancy. Now, compute the withholding tax payable, if any, and state two reasons for withholding taxes. So let's take the 10% out of here. So when we are taking the 10% of 3,300,000, when you take it out, it will be left with 2,700 for goods. So 2,700 for goods. The rates above the when you transfer goods more than 2,000 Ghana cedi, the rate is 3%, and there's the amount. Dividend is 8%. We calculated the dividend of 10%, 8%, and this is it here. Now, the services here are for training and then we so 7.5, 7.5. This is what we are having here. Let me see. All right. So 7.5, then works two is 2 million, which is more than works is more than 2,000, and then it's also what at 5%. So this is what we get, and this is our total liability. So these are the reasons for withholding taxes: ensure timely tax collection, reduce tax evasion, simplify tax compliances, spread tax payments over time, encourage compliances by withholding agents, support government revenue mobilization, ability to non-residents. Right, let's go to the next question. See, he is saying that a resident individual receive interest for the following: resident financial institution bank 10,000, Pearl Microfinance 9,000, ABC Limited 8,000. You have been invited to help with the possible withholding tax treatment of the above. Compute the taxes payable on my quotex and comment on the payments of interest. So for interest by resident financial institution to an individual is exempt from tax. That's why the first two are exempt, nil, right? They are nil, and then the last one paid by ABC is not a resident financial institution, so it's what taxable at 1%. That's why you're seeing this here. Now D, what are the main benefits and qualifying conditions under the second tier mandatory? So this is it here. Can read through. Question 9 is asking for withholding tax is deducted at source by authorized agents and accounted later to the Commissioner General of Ghana. So state two merits and demerits of withholding tax regime. So these are the merits, and these are the demerits. So you can go to merits and then demerits. Let's look at B. B is also the same thing that we've been doing, right? We find all the shares available. There was a right issue to here. Fine, and then now we are not supposed to do this again. You know how to do it. Now, after getting everything, we compute the sum realized, the cost of shares and the commission, and get our tax gain. Here they asked us to uh, compute the capital tax gain tax if any. So capital gain is here. Capital gain going to be 15% times 6. Going to give us 4506, which I doubt that they will give us 20 questions like this, something that you do. It is too is simple, man. Simple. And then here, you see, they told us that we hadn't sold the shares for, right? Shares for 60,000, but don't be attempted to divide here because they said at the end, they said the current market price per share on the market is 1.12. So that's what you are supposed to use. Okay, you have to read all the questions. All right. So let's look at C to recompute the goods that they've given us, the gifts, this. Then you find your capital tax gain on it. Then the tax 12,000 at the graduated tax rate. Right? They're asking what he can do, whether to tax it differently or he can include it in what in his graduated tax rate. So you can go through. I've explained this up there, so it's just the same application. Now question 10. Question 10 is here where the reading. So this is basically what we've been doing the other now. So can go through. Then B. So B2 is going to use formula A times C over A plus B. That's what you are going to use. And I doubt that something like this will come in exams, but I don't know. It is possible, so you can go through it. Time is far gone. I have to go for class. All right. Thanks for your time and see you some other time. Have a good evening. You can check through. All right. See you. Have some.